Suprabhat, good morning. Let me thank IBN, all the organizers of IBN for giving me this wonderful opportunity to interact with each one of you. Today is a wonderful day. Today is an Amavasya. In certain culture, it is considered to be a very good day. So it's a very good day. I just finished my morning remembrance of all my three generations behind me. We do something called remembering on every Amavasya, three generations before. I just finished my puja and it's a wonderful day. I'm really looking forward to speaking with all of you. Just me, let me remember my gurus before I start. Guru Brahma, Guru Vishnu, Guru Devo Maheshwara, Guru Sakshat Parabrahma, Tasmai Sri Gurave Namaha. So I bow to the feet of all my gurus who are responsible for what I am today. So by remembering my gurus, let me just speak little bit about my background. The Guru has introduced, but still I belong to a little tiny, not village, it's a city from the deep south called Thiruvananthapuram. I was born and brought up there. I did my schooling till my graduation there. Then I moved to Mumbai. I did my post graduation in management from Mumbai University. Passed out in 1997. Since then, I've been working with in the financial services industry. I During that period, I worked with many organizations like Sundaram Mutual Fund, HDFC Mutual Fund, Franklin Templeton Mutual Fund, UTI, HSBC Bank, and ICICI Bank across 21 years. Last 5 6 years, I'm on my own. During this, I also pursued my further education. I am a certified financial planner from Financial Planning Standards Board of US, and also I'm a charter holder, CFA charter holder, US CFA, Chartered Financial Analyst. I am a chart. These are the two professional qualification I hold, and at present I'm a freelance corporate trainer. I train people who sell investment products. I also practice as an investment consultant. I help people with their money planning, their investments, and also I teach in Christ University Bangalore as an adjunct faculty for the last 6 years. A couple of days I go to the campus and teach investment related subjects to college students. So that's my background. I'm also on the uh, other thing about other than this work I do. I'm into fitness. I do run. I used to be a long distance runner. Of late, I have reduced it to 5 kilometers and 10 kilometers. So and also I'm into little bit into spirituality, meditation. So that's about myself. And let's quickly jump into the today's topic, retirement planning. So it's a very, very important topic. Most of the time, the one which is mostly ignored. So today, what I'm going to do is that I'm going to take you through step by step into retirement planning. The reason why, what is retirement planning, the importance of retirement planning, why you should be doing retirement planning, and what are the two phases of retirement planning: accumulation and decumulation phase, and the math of retirement planning. So I am going to do live retirement corpus calculation for people who are interested to come up and tell their numbers. As we speak, I will tell you what kind of money you should retire with to have a comfortable life. As we are going towards the second half of the program, people can come up, and if you are okay to tell your numbers, I will tell you what kind of retirement corpus you should retire with to have a comfortable life. Let me start with the first thing. There are only two risks in life. Okay, yesterday I had posted this in our WhatsApp group. There are only two risks in life with respect to money: the risk of dying early, the risk of living long. The risk of dying early is the easiest thing which we can manage, because if you die early, the people who depend upon your income will be really in left in trouble. So the easiest thing to manage is that when the risk of dying early can be managed by buying an insurance policy. Most importantly, that insurance policy should be a term insurance policy. There are many types of insurance policies available in the market, and to be very honest, the most missold product among financial products is an insurance policy. And when you walk into any kind of an organization which sells insurance policy, unfortunately, people try to sell you a product which benefits more the seller than the buyer. So unfortunately, people sell you a product where commissions are high, expenses are very high, because on an ordinary person, you may not know the nuances of an insurance product. So people tend to buy into a wrong product, high expense product. Ideally, you should be buying a term insurance policy for managing the risk of dying too early, which will give your family some kind of a net to fall back upon. This should be ideally a term insurance policy. So if you ask me, my belief is that you should not club insurance with investments. Insurance should be kept separately. Insurance should be kept separately. So ideally, you should be buying an insurance policy, which is a term insurance policy. There are different ways to arrive at the value of the term insurance policy which you should be buying. In insurance, there's a concept called human life value approach and income replacement approach. You can use any of these methods. I'm not getting into the nuances, because one of these ways I can figure out, or any financial planner or any investment consultant can figure out what kind of value of insurance you should be ideally holding. So number one, so risk of dying early is the easiest thing to manage. You can buy an insurance policy, ideally term insurance policy, low cost. If you survive the term, you will not get anything back. During the term, if something happens to you, your kith and kin will get some money to manage themselves and their future. So now, then comes the biggest risk, the risk of living long. See, the risk of living long is looming large. It is in the horizon, and there are numbers which suggest today that the biggest risk for all of us, the universal risk is risk of living long. The longevity numbers are improving. In 1947, when India got independence, our average longevity of an Indian was 32 to 35 years. Now, as I speak to you, the longevity is touching 70 plus. For male, and if you are female in India, you are going to live 2, 3 more years than average male life. And if you are, there are certain states in India where the longevity is much, much higher. So the state where I am coming from, Kerala, the longevity is already touched 80. Men live till 80, 81, women live till 84, 85. So every 10 years, every decade, our longevity is increasing by 2 to 3 years on an average. So the probability of people who are sitting here living till the age of 80, 85 is very high. So that is the one important reason why retirement planning becomes extremely, extremely important. See, the retirement planning, mostly people work till the age of 55, 60. Even if you are a business person, you would like to take things little easier once you cross a certain age, though nobody will say that I want to completely off from the business. But at least if you want to don't want to take much of stress, you want to be little relaxed, and you want to do a lot of other things, pursue other things in life, in the evening of your life, then you want to take it easy. You need to create a financial independence or financial freedom for yourself at some point in time in your life. That is why retirement planning becomes extremely, extremely important. So the from the age, suppose I assume that you work till the age of 60, or you do business till the age of 60, and you say I'm no more actively going to get involved in money making, and I want to have a life in my terms, and I want to have a comfortable 20, 25 years pursuing a lot of things which I want. So you need to be financially independent. So the 25, 30 years of life, are you planned to live without earning? Do you have something which gives you a regular income which will take care of the next 25, 30 years? Very, very important thing to look at. That is the thing which we need to plan for. And most importantly, we are all living, we will live long, but at a cost. Today, post retirement life has got a lot of challenges. The one is the healthcare. See, healthcare is an industry where the inflation is in double digits. 10% is where the healthcare inflation is today. Just for the sake of, on the lighter side, I would like to tell you that if you by your bad luck, if you get admitted to a hospital today, even if you spend 2 or 3 days, you know what kind of hospital bills we will end up with. So there's a joke among in our industry. If I walk in front of Manipal Hospital in Old Airport Road, I will be charged 10,000 rupees. That is a kind of expenditure that we are talking about in healthcare industry. So on an average, today lifestyle diseases are catching up. People do take medicines for sugar, pressure, cholesterol, many kind of lifestyle disease. And once you are started on the medicine, and it's a lifelong medication. And I have my mother. I lost my father a year and a half back, and my mother is with me. In a month I spend 5,500 rupees on an average on her medication. She's 78 years. So I'm telling you, the this is going to increase day by day. So we are to live at a cost. We will live at a cost, and cost of healthcare is going to be big. So you need to keep that in mind. The cost of living itself will going to go up. So can you? Many people think that we can depend on our children to lead our post-retired life. If I tell you, this is the biggest fiction you can ever think of. If However good your children may be, the possibility of children financially taking care of parents, I don't think it will be a reality in the days to come. So and also you in your old age doesn't want to financially depend on somebody else. And when you start depending somebody financially, and you cannot live on your terms. So depending on somebody else financially at an age when you want to enjoy your life will make your life miserable. And you want to be independent as much as possible. So financially becoming independent for retirement, being prepared for retirement is very, 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 very important. So it is better to start as early as possible, because retirement planning is not an easy thing as people think. But if you do it correctly early, you will have a smooth and easy retired life. The reason again I'm telling you, the thing is that earlier days, there used to be most of the people in India used to be working in a job which used to give them pension. So both my parents work for State Bank, and both of them had pension. So today I am a private worker. I am now doing something on my own. I don't have a pension to fall back upon. So most of the jobs, even somebody is working in a private sector job, today there is no pension. So the pension system works like this. There are two types of things which an employer can do: defined benefit plan and defined contribution plan. Defined benefit plan used to be the earlier thing where you contribute some a certain percentage of your basic salary. The employer contributes a certain percentage of basic salary. It is going it will go to a fund which will be managed by the employer. And you will be assured of a certain cash flows once you retire till you die, and some cash flow will continue to your spouse till she dies. Family pension concept also was there, based on inflation adjusted. Your pension will keep increasing based on inflation. That was defined benefit plan. That is no more in existence. Even for government employees, there is no defined benefit plan. Today everything is defined contribution plan, where you contribute, the government or your employer contributes, and you will be given your PF money, your gratuity money when you retire, and you need to manage that money till you die. So that is how one should be worried about. That's how the things are. So one should be really worried about how you are going to manage that money post retirement, to create cash flow streams which will help you to live a comfortable life post retirement. So most of us here, again I want to touch upon entrepreneurs. We have a lot of entrepreneurs here. So entrepreneurs do a big mistake. So I do specialize in helping entrepreneurs, because the biggest mistake most of the entrepreneurs do is that they don't separate their personal wealth from the business money. They club everything together. Something happens to their business, their personal life also gets affected. So most of the time, especially for entrepreneurs, it's very, very important to separate their personal money from the business money and manage it separately, especially for retirement. So you cannot say that I will put everything back into my business. At some point in time I will sell my business and I will have money to live a retired life. So business is also at times uncertain. I'm not sounding negative. If something goes wrong, your business goes wrong, you don't have any savings other than your business. I have known many cases where people are on the streets, people who have not managed their money properly. So very very important to for especially for entrepreneurs also to have a plan of retirement. I'm not encouraging people to come out of the business too soon. In case of you need to do that, there should be a backup plan for retired life. So even for entrepreneurs, retirement planning is very very important. So the reason why we should do retirement planning is um, the longevity, healthcare expenses, and also not you cannot depend on your children to take you through through the retired life. And longevity is increasing day by day, and your healthcare expenses are increasing. And today if you look at a lot of old age homes are coming where you can go and buy an apartment and live, but there's a cost to it. There is a concept of nana nani homes in a city called Coimbatore. There is a lot of old age homes coming up in Hosur in near Bangalore. There are a lot of things happening in Chennai. It's an industry, flourishing industry, where but everything requires money to go and live, even if you're planning to live somewhere there. So the single biggest challenge is to have enough money and to create a cash flow stream to maintain your life post retirement. So what should we do? What should we do? It's a very vast topic. I am going to um, restrict myself to another 10 minutes of talk. Then I will be more happy to answer a lot of your queries and speak more about how to go about these things, if anybody has individual queries as well. So there are basically two phases in retirement: accumulation phase and decumulation phase. Accumulation phase is where when we earn money, that time we need to start um, uh, creating a corpus towards retirement. The key here is in accumulation stage, most people tend to ignore the retirement, because when I speak to somebody who's 25, 30, 35-year old, or even a 40-year old, they say that my retirement is far off. Why should I start planning and investing for retirement right now? So that is the issue. So people think that I have enough time, but earlier you start, easier it is to plan for retirement, long term goals. You have more time, you have more time to build your corpus. So there is a concept called power of compounding. Albert Einstein called this as the eighth wonder of the world. Power of compounding is eighth wonder of the world. See, what is power of compounding? We have all learned a concept of simple interest and compound interest in our schools in 7th 8th standard. So I is equal to PNR is the simple interest, the principal divided by number of years into rate of return is your corpus, if it is simple interest. But if you just make simple interest, your money will not grow. You have to make your money work for you. That is, you have to earn compound interest. Interest should earn interest. So what is the formula for compound interest? That is future value, that is your money corpus, is equal to present value multiplied by, within brackets, 1 plus rate of return, closing the bracket, 1 plus r closed bracket, to the power of n. N is the number of years. So your future value, the corpus, the future wealth you are going to build, is a function of how much money you are going to invest today, at what rate it is growing, and how long it is going to stay invested. So among these three variables which will determine your wealth creation, that is how much you are going to invest, the rate of return you are going to make compounded, and the number of years you are going to stay invested. These three will determine the outcome of your corpus or the money you are going to make. So if I have to simply ask you one question, which of these three factors will have the maximum impact on the money you are going to make? Whether the money you invest, the rate of return you are going to make, or the number of years you are going to stay invested? Any of the people in the panel would like to answer this question? Make an attempt, whether it's the amount of money you are investing, the rate of return you are going to make, or the number of years you are staying invested, which is going to have a maximum impact in your outcome of wealth creation. Anyone from the panel would like to answer this? Make an attempt. Mr. DK Jain from the chat is he's saying that it's return on investment. Anybody else would like to type also? It's okay. Chaitra also says rate of interest. Uh, anyway, a couple of answers I have got. So unfortunately, it is not the rate of interest which will have the maximum impact. Bhaskar says, I would say all three. No, the maximum impact is for the term n, that is number of years. N is an exponential term in the equation. More time you give your money to grow, it will multiply. The time you give is the most important thing. Earlier you start, longer you stay, the money will grow bigger. So the time is the most important element in the compounding equation. So any exponential term in any equation will have the maximum impact, which all we know. Time. So that is why we keep telling people, don't waste time. Start early, and invest consistently, and stay put for a longer duration of time. It's a matter of patience. If you don't have patience, you will become a patient in investing. I will here like to quote Mr. Warren Buffett. All of you know Warren Buffett is the most successful investor in the world. He's in his 90s, and he's the most richest person, one of the richest person in the world. And he made most of his wealth after the age of 54. He started investing from very young age. His wealth multiplied. His wealth multiplied after 25. Start multiplying after 25, 30 years, and it multiplied at a much higher rate. Once it starts reaching a certain level, the multiplication goes bigger numbers. So somebody went to Warren Buffett and asked him, "Sir, I will give you money. Can you make it multiply very fast? Can you double it, triple it very fast?" So what was his answer? Very interesting answer. I'm quoting Warren Buffett. He told that person only one thing: it requires time. Time is a very important thing. It requires time to do anything. Any good thing takes time to materialize. So he gave an analogy. He says that I cannot have a baby by making 9 ladies pregnant in 1 month. I need to have one lady pregnant for 9 months and wait um, to have a baby. So it takes 9 months to have a baby. You cannot have a baby in 1 month by making 9 ladies pregnant. That's the answer Mr. Warren Buffett gave. Though it looks a little vulgar, but that's a very nice example. You need time in on your hand to make money. So money is making money is not easy. If investing is like investing. Another quote on the investment is that investing is like painting and waiting for paint to dry, or watching the grass grow. It takes time. If you want to make quick money, people say that you should go to Las Vegas, where you should gamble. So money making is a slow process, effective process, and it takes time. And compounding is magic. It works better if you stay invested for a longer period of time. And when you are investing, the most important thing in accumulation phase is identifying how much money you need at the time of retirement corpus. Number one, how much time you have to retirement. Suppose you are 40, you want to retire at 60, you have 20 years to retirement. So you have 20 years with you. Then we also do something called what is your current expenditure. Suppose we will ask the retired person to think that today you are 60, you may be 40 today. Think that you are 60 today, you are retiring today. You have all other things of yours taken care of. You have your own house, you have no EMIs to pay, your children are settled. What will be your monthly expenditure to run your household as on today? Think that you are 60. Suppose somebody will say, in a month I need 50,000 or 1 lakh. We put an factor of inflation of 5 or 6% and do a calculation for 20 years, and will say that today, if you are 60, you have to spend 50,000 a month, that is 6 lakhs a year. When you retire after 20 years, the same 6 lakhs you are telling today will be 12 lakhs or 15 lakhs. We do that calculation first. Then based on that number, at the age of 60, the first year of retirement, you may require 15 lakhs, but that is not going to be constant till you die, because every year there is a inflation factor adding. What is 15 lakhs in the first year, you may not live with the 15 lakhs in the second year of retirement. You have 6% increased to 15 lakhs into 1.06, like that. If you are living till the age of 90, every year it is going to increase. So based on that number, and the inflation of 5 or 6% post retirement, and also after retirement you cannot take risk, you will invest in a relatively safer investment getting 7 or 8%. We do a math and tell you, if you are investing post retirement at a 6 or 7% return and your inflation is 5%, if your corpus has to last for 25-30 years, what kind of money with which you should retire? That calculation we do. Then that may be a 2 crore or number, or a 2.5 crore number, or 3 crore number. Then we do a backward calculation telling that if you are 40, you need to accumulate 2 crore at the time of 60. How much you should start saving every month, or lump sum investing, how much you should add, what kind of return you should make to lead to that goal. Along with that, we also tell that you should also have a health insurance policy taken at the earliest, which can be renewed throughout your lifetime to take care of your healthcare expenses throughout your life. So earlier you start, a lesser amount you should save for towards your retirement. Later you start, more money you may have to save. So every year lost, as time lost, is it will add more pressure on you to save more. And again, while you are investing money, we don't invest all the money in one place. There is a concept called asset allocation. Asset allocation is a simple concept of not putting all your eggs in one basket. So you should divide your investments into different types of investments. You may invest something in FD kind of a thing, which is typically we called it debt in our parlance, investment parlance. Then something in shares or share related mutual funds, that is called equity in our parlance. Then something you will invest in gold, not necessarily ornaments, paper gold or gold bars. This is called commodities or gold. All these things are diversified, then you will get a better return. Your risk is well managed based on your ability and willingness to take risk. So one of the key things an investment planner will do is, once I arrive at the corpus required, he knows the time available, how much you can save. All those numbers are analyzed. I will ask you, what is your current income expenditure, how much you can save. Based on that, a plan is given. Not the plan involves investing in multiple investment options and continuously monitoring, and help you navigate market turbulences, and we comfortably take you to your goal, which involves periodic rebalancing, periodic review. All those things are done by the financial consultant for you. And most of the people think that this can be done by themselves. Today Google is a big Google guru people depend on. That's not ideally, that's not the way. You should need a professional person to manage your money. Please understand, your money you are earning is through hard work, that needs to be managed. Your money needs a good professional who can take care of it. So it's better that these things are done by a professional person. Though it may involve a little bit of cost, that cost has needs to be incurred for to get the peace of mind. So self medication is not suggested. It is better to consult somebody to get a retirement plan as the way I have suggested. Once you create the retirement plan and go through this process, periodic review, periodic balancing, all those things are done, you will be reaching the goal. Post retirement, one can easily manage this money to create cash flows, which will help you to go through the retirement phase comfortably. Again, it's very, very important in the accumulation phase to start early, stay invested, have a good plan based on number crunching. Your expenditure at the time of retirement is very important number. Inflation assumption is important number. The income return assumption is important number. Post retirement and pre retirement for this calculations. And most important concept each one of you should know before I open it for Q&A is that the factor of inflation. See, the most important thing, which is a big factor which affects each one of us, is the factor of inflation. So if you, a small example, you have your son or daughter's birthday coming up, you want to give them um, some gift which is worth 10,000 rupees today. You want to give them a good bicycle, but the kid says that after 1 year, I need bicycle. Dad, I don't need this bicycle right now. You are putting this 10,000 rupees in State Bank of India deposit for 1 year, which gives you 5% interest. After 1 year, you will get 10,500 rupees, and you and your daughter or son are going to the same cycle shop to buy the cycle. To your surprise, the cycle today is costing 11,000 rupees or 10,800 rupees. So what has happened to your money? What has happened? You had 10,000 rupees, which has become 10,500. What you had to buy for 10,000 last year, today it's costing 10,800. So what is the scenario here? Your inflation was 8%. The cost of cycle has moved up from 10,000 to 10,800. Your investment has given you a return of 10,000 to 10,500, which is 5%. Your investment return is less than inflation. What does that mean? Your purchasing power has come down. You have eroded your wealth. I repeat, when your return is less than inflation, your purchasing power comes down, your wealth is eroding. When you are in, when you, if you have made an 8% return, 10,000 has become 10,800, you could have bought the cycle. That means you are preserving your purchasing power, you are preserving your wealth. When your return from investment is equal to inflation, you are preserving your wealth. Even when you actually, if you had made a return of 10%, and you would have bought a cycle for 10,800, still you will have 200 rupees left with you. That is wealth creation, your purchasing power going up. The key to investment success is building an investment plan which can beat inflation and create wealth for you. So ideally, your investment should beat inflation. You should have investment plans beating inflation. Then that is what we should be looking at. So when you are making the investment plan, you need to take that risk and move into investing in assets which are giving better return than inflation. Just touching upon where you will get better return than inflation, return commensurate with risk. If you don't take risk, you will not get return. If you are putting your money in FD, post office savings, you will get that basic return equal to inflation or closer to inflation. If you keep money in your savings bank account, you will lose your purchasing power. Your money will not even grow in line with inflation. So if you want to make money, you need to invest in businesses which are creating wealth for people. So who makes more money, a businessman or a person who's making salary? Of course a businessman. But if you tell, many of the people here are will be telling me, I myself is a business person, why should I invest in equities? No, you are doing a business which is very specific to your area, and one business you are involved. So if you put all your money in your business, you are investing in one business, one company. When you are investing through a mutual fund, when you are investing in stock market, you are getting exposure to different businesses, different business people's skills, different types of industries, within an industry different types of companies. Your risk is diversified. So that is why you should invest in different stocks or different mutual funds. Investing in different stocks, your risk is diversified. You get the benefit of a software industry, participating in pharma industry, telecom industry, everything. The easiest way to do is don't buy stocks, buy mutual funds, buy diversified mutual funds. In India, the track record of diversified mutual funds, you can see, in existence for 25-30 years, it has delivered superior returns. So what kind of returns I should expect when I'm investing in share market, equity market, or equity market related mutual funds? I'm giving you a framework that works across the globe. What is the country's economic growth? That will get reflected in stock market over a longer period of time. The economic growth of the country is measured by gross domestic product growth, GDP growth. GDP consists of three sectors: primary sector, agriculture; secondary is manufacturing; tertiary is services sector. Agriculture contributes to around less than 20% today in India, but it employs 42% of the people. Your services sector contribute to 55% odd, the rest is in manufacturing. So all these stocks which are listed in stock market are from mostly from manufacturing and services sector. Some of the agriculture GDP also gets reflected in stock market. So our GDP is growing at a real rate without inflation at around 6 to 7%. If I add inflation, which is around 5-6%, our total nominal GDP growth is around 12%. That is real GDP growth net of inflation of 6 to 7%, plus an inflation of 5 to 6% of adding up to nominal GDP growth of 11 to 12%. So if you are investing in Indian stock markets over a longer period of time, you should be able to generate that kind of a return. If you are smart enough, you will be able to make a little more return than that. If you can compound your money at 10 to 12% over 15, 20, 25 years, you can create excellent wealth. This is on rupee terms. If you are outside India, in dollar terms, if we can compound at 5-6%, where the inflation is 2% in US, you can make tremendous wealth. So the key is identifying your retirement corpus through proper planning, giving yourself a long time horizon, doing a proper investment asset allocation, investing in multiple assets, beating inflation, continuously tracking, doing rebalancing, portfolio monitoring, you'll be able to reach your retirement goal and comfortably manage your retirement. So in the accumulation phase, if you do plan, your decumulation phase will be very, very good. And longevity is increasing, healthcare expenses are increasing. Better late than never. Use the power of compounding and take the help of a professional and plan your retirement. I can keep going speaking on this subject. It's very I'm very passionate about speaking on this, but I'm stopping here. More than half an hour I've spoken. If anybody wants to do a live calculation of their retirement corpus, I have kept my Excel open. Anybody who are willing to share their numbers, I can give you a retirement corpus number in couple of minutes calculation.